Welcome to our Samvat special Indianomics. Here's wishing all of you a prosperous and great Samvat 2082. Well, the Indian economy has notched up many records as we stand at the start of Samvat 2082. The last available GDP number is a stunner at 7.8%, and just hours ago, the IMF has upped India's full-year growth forecast for the current year from 6.4 to 6.6%. The September CPI inflation stands at an 8-year low of 1.54%. The wholesale price index at 0.13%. I mean, next to nothing. This inflation index, WPI, has been below 4% for the past 3 years. And finally, the government and the Reserve Bank have given an extraordinary boost to the economy via huge rate cuts, 100 basis points, income tax cuts and GST cuts. So, how will the economy pan out in summer 2082? I have a panel of...
So what is your one main reason? आपका एक top एक ही reason जो है why you want to shift towards algo?
A top-notch economist to tell us just that. Samiran Chakrabarti, the chief economist from Citi India, Kaushik Das, the chief economist from Deutsche Bank, Upasana Bharadwaj, the chief economist from Kotak Mahindra Bank, and Madhavi Arora, the chief economist from Emkay Global. Ladies and gentlemen, an even house, thank you very much, and Diwali greetings to all of you. Well,
a somewhat complicated question to answer right now, because while we have a very decent September quarter behind us in terms of the high frequency indicators that we have tracked, it is likely to be again a 7% plus growth quarter in September. But going forward, there are two different tracks that we have to observe. One is the stimulus that has been given to the economy, how the consumers respond to the stimulus. And second is, if this tariff-related global shocks, they continue, then what kind of second round impact we start seeing in the second half of the fiscal. I think how these two things will balance out each other will determine how the second half is going to look like. We are relatively more optimistic that this size of the stimulus at more than 1% of GDP is clearly a very big one. So we understand that could be a debate on how much will be saved versus consumed, particularly when the market mood might not be that great. But beyond that, it's likely to have impact. One debate is also that whether the impact will be more on goods demand versus services demand. Our sense is that it could go more towards services than towards goods. And how the global situation is going to pan out is much harder to predict. In our baseline, we have taken that it might take some time for the tariff deal to fully come in for India. So this headwind can continue for a while. But even with that, we think it is possible that we clock a 7% GDP growth for the full year. Let's not forget that how the inflation numbers are panning out. Even for the December quarter, the GDP deflator is likely to be extremely low, which means that the real GDP growth will be much better compared to where the nominal GDP growth can be.
Okay, yeah, I was going to get that in, but I'm glad you brought it in. The WPI, there was a reason why I said the WPI is at 0.13%. That means that the nominal GDP is going to be deflated by a very, very small number, less than 1%, and that will make our GDP look good. But that's one thing, that's the statistical advantage. Madhavi Arora, you'll track a large number of companies and markets. So just one more word on consumption before I get to the other parameters. Are you getting a sense that your own growth forecasts may be bettered from the consumption numbers that you are getting so far?
So, Latha, the economic outlook has become a bit of a tug of war between whatever is happening on the external tariff-related headwinds, and also what's happening in the domestic economy with regard to lower inflation, consistent monetary easing in terms of transmission, a decent monsoon, the GST cuts and direct tax cuts. As of now, I think there's still a lot of noise in the data. One doesn't really know this consumption boost is basically a temporary pop-up, or actually it will have a more durable life to it. I still believe there's an income effect which is very dominating in the urban sector, which has been working its way through in terms of a lower urban consumption that will continue. Yes. My fear is that it could spill over to the semi-urban economy as well as we get into the next quarter or so, because all this while what we were seeing was largely the income story which was playing out in urban and rural had started to pick its pieces well after almost 7 years of being MIA, and was doing pretty decent. But I think the large chunk of tariff related hit would be actually felt in the semi-urban economy, the MSME led segments,
Yep.
which could actually probably lead to a much more weaker underlying growth story than what the GDP numbers would look to be because of the deflator effect.
No, I
there's
take
a lot
your
of
point.
noise.
I take your point that we underestimate the global impact, and it came in full force, didn't it, in 2008, 2009?
Historically, India has never been able to outdo the Asian growth trend. Even though we are a more domestic driven economy.
Absolutely, and the Asian growth trend, especially when you look at Indonesia, Malaysia, Thailand, is not a very positive trend, and we don't know how much of that. The inflation is rubbing off, then maybe the growth also will. But I'll give all of you a chance to speak on growth in a bit. Let me cover the other macroeconomic parameters which the markets are terribly interested. And to you, Kaushik, on that, we've got these extraordinary inflation numbers, and the Reserve Bank is again going to be red in the face and will have to bring it down. Where have they started? From 3.7% inflation down to 2.6 and probably now to 2.2 or 2.3. What's your estimate as to what will the inflation number come down to? And rate cuts, what are you expecting?
Latha, so, I was just looking at the inflation number today, and it looks like October, we are going to get, very low inflation number, the lowest on record. I think whatever index we have, probably we have to go back to the previous index to see if we get this kind of a number. So it could be close to zero. I'm saying, like I've written in my report, there's an outside chance that you can get an even negative year-on-year number if food prices kind of continue to remain weak in October. So we are talking about something like 0.4, 0.5% YOY growth in October. And what it does is basically it reduces the inflation average for October, December quarter, January, March, and even the next few quarters. So this fiscal year, as you mentioned, we could be as low as 2% or 2.1% compared to the 2.6 that RBI has just recently revised it down to. And it also reduces the forecast for next year. Instead of the 4.5 that we were predicting earlier, we now have a number like 4.2, 4.3, but my guess is we could go down to 4% even. And we are still yet to see the impact of the GST rates rationalization in the CPI, core CPI numbers. So that has still not come yet. So you'll probably see that through October, December quarter, which could reduce core inflation by 20, 30 basis points. Then you have this other impact, more structural impact of, the overcapacity in other countries coming into India, and you could have a disinflation impact. So basically inflation, if you have to take a call, probably the risk is biased to the downside. We know that there is a risk of food inflation, which can go up anytime, but even factoring in all that, probably next year we could be at 4.25.
So rate cut?
Yeah, so rate cut, my view. I thought October was the best time for RBI to cut already. If they have not done it, then December, they should not delay it any further. They should do a 25 basis points rate cut. And then it's a question of how much real rates differential you want to, maintain. So if your inflation next year is 4% average, then if you're at 5.25 on the policy rate, you're at 125 basis points, positive real rates. I think that's enough for the time being, given what Samiran said, the stimulus that has been given on the GST side. I'm also optimistic that in the next few weeks or months, you will hear more positive news on the tariff front for India. And that would, reduce some bit of stress that is going on. And, this GDP growth number obviously will surprise to the upside on the real GDP front. But I keep on stressing the fact that you have to look at the nominal GDP, which has been slowing for the last 3-4 years. That's where all the problem is. And that's why you're seeing it getting reflected in the stock markets, earnings estimate, nominal credit growth, tax collection. Everything is in terms of nominal GDP growth. And that's where focus should be, and not just on real GDP because of deflator pulling it up.
Absolutely. We will discuss growth a little more later on in the show. So Upasana, thank you very much for coming in your Diwali finally. I didn't miss the henna as well on your hands. What's your sense? Does the Reserve Bank now have space for 2 cuts and not just 1?
Latha, we do see scope for up to 50 basis of rate cut. Actually, until before the June policy, we were of the opinion that there is adequate room for RBI to go up to 5%. But of course, things did turn around. And since the GST announcement, we have been expecting that, even rather, I would say before that, we were expecting this year's inflation reading to be sub 3%,
Yes.
which has further gone down to 2.1% now, given the recent numbers. And even as Kaushik pointed out, inflation trajectory not just for the next 1 or 2 quarters, but now for the full year.
This is the corporate language translator. So when you say this, they hear this. And that's how you make your own words sound weak.
Next year as well, we are looking at comfortable numbers, barring any shocks, of course. And going ahead into the fourth quarter of FY27 too, our estimates suggest that inflation could be 4 or at sub 4%. In that kind of an environment, 5.5% repo rate today, with of 3.7 estimates of ours for the fourth quarter FY27 gives about 1.9% as real rates. Now, that is something which I think is very high. And hence, there is adequate room for RBI to address growth and go ahead with about up to 50 basis. The only tricky part here is that the third quarter is going to be clouded, or rather, colored with all the euphoria because of festivals as well as GST related, excessive buying. So the corporate earnings data, the high frequency data, consumption linked, will be suggesting a decent reading.
Okay.
But I would agree that because the nominal GDP is something which is important to keep in sight, we should not lose sight of the nominal GDP growth, which could still be very muted.
And its weakness.
In all 50 basis rate cut, there is room for.
I have many more questions because the Reserve Bank has announced a volley of steps, draft steps on, allowing easier ECB loans, easier loaning by banks to Indian corporates, all those and their impact on growth coming up for you after the break. Welcome back to our Samvat special Indianomics. I've been speaking with 4 top-notch economists on how Samvat 2082 may pan out for India's macros. I've been speaking with Samiran Chakrabarti of Citi, Kaushik Das of Deutsche Bank, Upasana Bharadwaj of Kotak Bank, and Madhavi Arora of Emkay. Ladies and gentlemen, thank you very much for your patience. Before we went into the break, Samiran was talking about the currency trends. I'll just extend that question, Kaushik. There are a lot is pinned on the currency as well. Do you think that, we have weathered the worst? The rupee has depreciated enough and now we may see a ranged behavior?
So let me make a few points, Latha, on rupee.
Sure.
First of all, you have to understand that it's not a current account deficit problem anymore. Current account deficit is just 25, 50, to 30 billion, which is very small in India's context. The service exports and private remittances, they have helped a lot, and the current account is not a problem at all. But the problem is we are not even getting 25, 30 billion, to fund that current account deficit, very small current account deficit, and rupee is facing pressure because the capital account flow problem. And over there, if you look at FDI, the gross FDI is still okay. But we have seen a lot of repatriation of capital happening from 2022, precisely when the US interest rates went up. And a lot of money has been taken out to deploy more productively in US and other places.
Okay,
and
Kaushik, may I interrupt you there? I'm very sorry to interrupt your chain of thought. But, you have an interface with a global audience. And that's why I wanted to ask you, we have announced some very liberal ECB steps. Of course, they are draft. But a draft should definitely kindle some sentiment. Just about anyone can now give us an ECB loan. The pricing is now freed completely. We can raise 3-year ECBs. Otherwise, it was all 5 to 10 years. And end use has been seriously liberalized. Are you getting any sense from your foreign counterparts that next year can see a lot of ECBs in other ways by way of debt?
So that's why I was coming to that, because of net FDI being close to zero, and FI equities are also negative. We were lucky to get FI debt last year because of the bond index inclusion. Unless you have new index inclusion, that money is not going to come in that chunk. So what you're left with is basically some other flows that RBI has to incentivize to ensure that we are able to finance that current account deficit. And to that, extent, RBI has liberalized the ECB norms. We met a lot of foreign investors last week, and we discussed this ECB, rationalization on liberalization measures. People are obviously interested to bring in money, but these things take time. It's not like immediately it'll kind of come in. People have their plans, how much money they want to bring in into India based on their, different investment profile. And it just because liberalization has happened doesn't mean tomorrow the money will come in, but it enables or it creates a condition where more capital flows can come in. And that's what I think the RBI mentioned in their monetary policy statement, that they'll take appropriate steps. Now, things like FIIs are function of market, sentiments, what Samiran said. If there's a rotation trade that happens, money comes from China equities to Indian equities that you can't time, that can help.
Yes.
The trade tariff deal, I'm more optimistic. As I told you, I think more positive news will come in the next few weeks or so. So you can see more flows come into India that can help the rupee. But you need more structural reforms and more liberalization, because we need foreign capital to fund our investment needs at the end of the day. So I think the ECB will pick up over the next few quarters, but it's not something which will give you, immediate joy, but RBI is moving in the right direction. And rupee, I feel the worst is done. When rupee came down to 84 in May, we did not change our forecast and we kept it at 88 year end. Now that rupee had gone close to 89, we didn't change our forecast from 88. I think it can fall below 88, as we have seen today, as you get more positive news. But at some point at 87 or close to that, RBI will have to buy dollars because they've lost a lot of reserves. And reserves, as I keep on saying, don't see in terms of absolute numbers. First of all, the absolute headline FX reserves, you have to subtract the net forwards short position that's there. And then you have to calculate it in terms of ratios. And in ratio terms, the nominal GDP and everything has grown over the last 1 year. So if you don't increase your FX reserves, the ratios kind of keep on moderating. Okay. So at the point of time, RBI will have to buy those reserves. And therefore, I think the rupee will be a, depreciating currency every year, 2-3%. But the range will be controlled by RBI, and you'll see range moving slowly towards 90 next year, but not this year. I think this year will.
We have done our work for this year. I take your point, and in any case, we should not be looking at it as negative at all, because that has been the best way to beat the tariff challenge as well. Now, let me come back to the growth story. Upasana, it's not just the ECB Brahmastra that has been unleashed, if you please. It's not yet unleashed, but it's waiting to happen. There have also been a lot of, encouragement given to banks. Banks are now becoming to be treated like business-like organizations, allowed to now fund acquisitions. Also, unlimited loans against debt instruments, listed debt. There has been a lot of liberalization. Given all this and the encouragement given to consumption, are you getting a sense that the animal spirits return? Are you getting a sense that capex or just loan growth is likely to pick up? That magic intangible, do you see it clicking?
Yeah, Latha, I think, the prospects have clearly improved. At this point, RBI's prudential norms, liberalization of some of these, hardships which the banks were going through, I think that has definitely helped. And at the same time, the kind of, a fiscal stimulus that the economy has got from the government, that is likely to provide fair amount of confidence amongst the, corporates in terms of sustainability of demand. Now, just to mention one thing, it is by the time we will be done with probably GST and income tax related, benefits, at some point by the turn of FY27, we will also be seeing benefits from the 8th pay commission coming into play. Okay. So I guess we do have a long-term view which suggests that domestic demand could remain firm. Having said that, I would again revert back to all the other panelists who have mentioned about the headwinds from tariff. Yeah. We have to consider that in mind, that we don't know how long this problem comes, because the tariff related problems are more worrisome when we look at the labor intensive sectors, because their exposure to the US is very high, and the spillovers could be there wherein it could counter the positives in consumption that is coming. because of the fiscal stimulus. So I think we have to balance it out. But clearly, yes, at least the foundations are clear from a financing perspective, from a sustainability of domestic demand, which is being provided through fiscal stimulus. And I would say that somewhere in the coming few quarters, we should start seeing a more visible improvement in the private capex cycle.
Okay, so Madhavi, would you extend that argument to saying that we can see a much better improvement in bank loan growth?
I agree, Latha, because the policymakers' focus since the beginning of the year has been to improve the transmission of the past cuts. And that is what they've continued between June to October, even though they've not necessarily cut rates. And that is, I think, a very positive thing, because all this while, at least in the last 1.5 years, what we were seeing was that the RBI's balance sheet was, growing at a very tepid pace. That is where they try to actually improve, the transmission by not only increasing their balance sheet, but also ensuring the base money actually grows in the economy. And the recent step that RBI has taken with regard to easing the financial conditions should ideally lead to a much better, credit offtake outlook. But of course, there is still a bit of a demand-supply mismatch that we are seeing, and it could still take some time for us to see a more durable uptick in industrial demand and consumer demand alike. So, but definitely the policymakers have ensured that we don't go down from here on. Yep. For us to see a V-shaped recovery, I think it's going to be a much longer process. But we are largely now in a U-shape or a dragged growth story.
Okay.
But at least it's not going down from here on.
No, fair. I take your point entirely. I mean, there's been a volley of steps on consumption, on liberalizing the animal spirits of bankers to go ahead and give loans. And of course, taking foreign loans. A whole host of things have been done. All of this is held back because of this kind of fear we have of the global economy. Samiran, hoping that, things settle down in the coming year. After all, Trump also will be worried about getting through his midterm November polls next year. So assuming that things settle down globally and we don't have an everyday tweet war, do you think all these steps can lead to a very good FY27? Would you say there is an upside risk to FY27 Indian GDP, other things being equal?
So, not a very, in a short, crisp way, one can say that the extent of cyclical stimulus that we have provided, that's probably larger than the extent of the cyclical problem that we had. Oh. And that's why I'm hopeful that this will show up in growth numbers. The little bit challenge always is that the markets react to any bad news immediately, but take some time to digest the good news and react to it. So we are probably passing through that sort of a period where there is not enough appreciation of the extent of the stimulus that has been provided in the system, fiscal policy, monetary policy, regulatory policy, everything. And I think more is in the pipeline. So that way, it is okay to think of a much better cyclical recovery. However, both the global context as well as some of India's more medium-term structural issues, they are not to be tackled through cyclical policies only. Yeah. And to what extent they create headwinds, that's something that we have to closely watch. But purely from a cyclical standpoint, I think we are doing quite well.
Okay. Well, on that optimistic note, let's wind up this discussion. Samiran, Kaushik, Upasana and Madhavi, thank you very much for lighting up our Samvat celebration with your presence and with what I would call largely cautiously optimistic views. At least a cyclical breakout of the Indian economy into better times looks on the anvil. And, so much depends on the market. We've had a lot of Samvat market chats. If we can see the AI bubble kind of receding a bit, then, money coming from Korea to India, they were the beneficiaries of this AI wave. If something of that can come, a wealth effect can be created in India. We are too much of a market economy now. We are invested heavily in stock markets, and a turn of that tide can make a very big difference to the animal spirits. Thank you very much and have a great summer 2018.